Hello friends, welcome to another module of financial management. This module, that is unit number 14, will help you understand receivable management. Let's move further to understand what all things this module will help us. This module will help us to understand cost associated with maintaining receivables, credit policy, variables, evaluation of credit policy. Before we continue further, let me ask you, what do you understand by receivables? Assume you are running a manufacturing unit and in your accounts you see certain word which is written as receivables. What comes to your mind when I say receivables? Yes, receivable is something that we have to receive. Now, in a company, in an organization or in a firm, from what all source you get receivables, you need to understand that. Normally, a firm sells good. When you sell good, you earn revenue. But is it possible to sell everything on the cash? No. There are certain things, certain time you need to sell on credit also. In the present era of intense competition, business firms to improve their sale offer lot of credit policies to the customer or sells the goods on credit. And when you sell the goods on the credit, it affects your all the sales which are sold on credit is nothing but your receivables. So if I have to explain you the meaning of receivable, receivables are the direct result of credit. Sales that are restored by the firm to push up its sales, which ultimately results in pushing up the profit earned by the firm. So if I am selling something on credit, my profit is blocked for a certain period. Actually, it is in the books of account, it shows that the sale, but it's not actually sales, it's a credit sale. It is absolute sale once you receive the cash against that, right? So those are called as receivables. Now, in this slide, we will understand what are the costs associated with maintaining receivables. Once you have receivables, you need to maintain those receivables. So these receivables are 4 different varieties of the cost which are associated with maintaining the receivables. First is capital cost. As the name says, capital cost, it is nothing but the firm sells on good on credit to achieve good sales, right? Selling goods on credit has consequences of blocking the firm resource, right? Your resources block, and these are receivables. And all these receivables that are credit sales are having certain time gaps, right? So certain time gaps, because that amount will be recovered later on. And this value, there are certain value for these receivables. This is nothing but the capital cost, right? The another cost is administration cost. When I say administration cost, the firm sells goods on credit and it incurs 2 types of administration cost. First is credit investigation and supervision cost, and second is collection cost. What is credit investigation and supervision cost? That means that the goods sold on credit had to be investigated whether the goods have reached to the customer properly and it is lying with the customer. Customer or the seller has accepted the product and he has given you a signing challan or invoice which states that yes, good purchase on this credit. This money I have to pay later or somewhere. So this investigation is nothing but an administration cost. You need to supervise what is the amount or what is the goods that is sold on credit. Now for say all the sales what you made on credit, you need to do certain follow-up, you need to maintain books of account, you need to maintain that track record of all the goods sold on credit. So this money you need to collect it back. For collecting, there are certain administrative features which a company adopt. For example, company appoints collection executive who goes and recover the cost. So this is nothing but this cost which is incurred on the collection executives and maintenance of the record are nothing but the collection cost. The next cost is delinquency cost. What is the delinquency cost? We will understand now. As a firm, you incur this cost when customer fails to pay the amount on the expiry of credit period. That is, suppose you have given a credit period of 30 days and the customer does not pay you on 30 days. The cost takes the form of sending reminders and legal charges. So all these charges, legal charges, reminders and other legal action you take, cases, you file a suit, all these charges are nothing but a delinquency cost. And the next is bad debt or default cost. All the sales what you made on credit, not necessary will come back to you as a cash. There would be something which you will not recover. You will say that you will not, the seller has run away. The customer is not able to give the money on time. All this cost what you incurred are nothing but the bad debts or the default cost. Bad debts, it is nothing but the cost which you are not going to recover. The chances of recovery is very less. All this are your bad debts. We'll move further. We'll go to the next slide which talks about credit policy variable. Now every company has its own credit policy and this policy differs from company to company. There are 4 varieties of the cost associated in maintaining receivables. First is credit standard, second is credit period, the third is cash discount, fourth is collection program. Under credit standard, there are further 4 varieties. The first is credit rating, references, average payment period and the ratio analysis. Let's understand each in details. Credit standard. When I say credit standard, companies maintain certain standard of credit that up to this percentage of the goods can be sold on credit. Particular percentage can be sold on credit. Rest all has to go on the cash sales. The credit sale primarily will have lot of cost incurred, whereas a cash sale will have less of cost incurred. So this credit standard is the term credit standard. When I say it refers to the criteria for extending credit to the customer. The basis of setting credit standards are credit ratings, references, average payment period and ratio analysis. We'll go further. The credit period. When I say credit period, for example, the company generally offers 20 days credit. That means the payment can be paid to the company within 20 days. In case within 20 days you are not paying, the company may charge certain additional penalty or fine or a late charge to you. So the credit period is nothing but the time period, the time lag which company provides to the seller that this is a time when you can pay it on the credit. Cash discount. These are the very common feature which is available in today's term. When you take something on the cash, the company offers certain discount. Why do the company offer this discount? Nothing. The matter is, if I am selling on the credit, I will have to incur a lot of cost. What we discussed in the earlier slide. That is capital cost, administration cost, delinquency cost, bad debts and other cost. So here when I am selling anything on the cash, so I am saving this all four cost what we discussed earlier. So company extended certain cash discount. The company might give you a little lesser rate than the credit terms. So that is what is nothing but the cash discount is all about. When I say collection program, as the name says, collection program, the success of this program purely depends upon the collection policy pursued by the firm. Normally the objective of the collection policy is to achieve a timely collection of receivables. If you realize funds locked in receivables and minimizing the incidence of bad debts are the objectives of the collection policies. The collection program normally in today's term consists of the many things. Few are like monitoring the receivables, reminding customers about the due date of payment, online interaction through electronic media, initiating legal costs to recover the amount from the overdue customer, and many more. Let's move further. Now we'll go to evaluation of credit policy. When I say evaluation of the credit policy, it is nothing but the optimum credit policy is one which would maximize the value of the firm. The value of the firm is maximized when the incremental rate of return on an investment is always equal to the incremental cost of fund used to finance the investment. So, individual evaluation of all the four earlier discussed credit policies are first credit standard and the second is credit period. When I say credit standard, it is nothing but my standard of the credit, what I give, normally what percentage. And credit period, it refers to the time period up to what I am offering a credit. Right? Any questions, friends? Let's move for the summary part. At the end of this module, we will summarize the learning for today. Let me ask you, what are the four varieties of credit policy variables? Do you remember? Credit policy variables are: first is credit standard, second is credit period, third is cash discount, and fourth is collection program. Right? And what are the various costs associated with maintaining receivables? The cost, if you remember, in the first slide we discussed. Yes, the cost associated with maintaining receivables are capital cost, administration cost, delinquency cost, bad debts or default cost. Any questions? Alright friend, thank you and take care. Have a great learning and have a great future ahead. Take care.